In this video, I'm going to be answering viewer questions. Feel free to leave questions in the comments section under the video, and I will try to make a video about it if it's something that I think most of the viewers on my channel would be interested in. I want to thank Hamilton RB for leaving this question, the suggestion for a video, and I also want to thank all of you for helping me reach almost 1 million views on my channel. So if you like my videos, click that little thumbs up under the video. If you like them, subscribe to my channel so that you see more of my videos. I'm told that this helps somehow get the videos seen by more people, and I love providing this free financial education. So let me answer the question that Hamilton RB suggested. Okay, possibly give examples of portfolios showing a low volatility portfolio, a retiree growth/income portfolio, and a strictly income one using ETFs. So just to explain that question a little bit more, he wants me to give examples of 3 different types of portfolios. Okay, so that's what I'll be addressing in this question. All right, so let me start by saying thank you for this great question. It is a very good question, and one that I would have certainly been asking about 20 years ago, prior to the bear markets that occurred in the 2000s decade. Those bear markets really influenced how I invest, and they taught me so much about investing. And if you haven't experienced a really hard economic time like we had back then I think it's important, it's useful to take that into consideration when investing and learning about investing. So that's what I try to do here on my channel. Now, let me go ahead and tell you that my response is going to be different from what you're going to hear on 99% of other YouTube videos and from other financial experts. And I'm also going to say that you're probably not going to like it. I will probably get a lot of thumbs down on these videos, as I frequently do, and that's because what I say is usually not what other people are saying, and that's because, like I said, the 2000s, the lessons from the 2000s, and the lessons from investing for 4 decades, over 4 decades now, I've learned stuff that makes me question the most common advice that I see here, and that's what I talk about here. So it's going to be different. Okay, now having said that, let me just say that's okay that it's different. I'm just sharing honestly what I've learned from going through those bull and bear markets. Okay, so I'm going to address each of the 3 portfolios that Hamilton asked me to give an example of, but I'm also going to share how I invest, and it sort of makes, that is a real conventional question that we would see, and because I do invest differently, the answers are not going to be simple. So I'm going to just give you that warning. Okay, so the very first example he wanted was a low volatility portfolio. Okay, so just a portfolio that doesn't have, those swings up and down. If I were looking for a portfolio with a low volatility, what I would do is I would look and allocate smartly. I've done another video on allocate smartly. I've done a couple, and I'll be addressing that more in the questions here today because I did have a question about that. And I would choose a portfolio with low drawdowns based on historical return data. And that data is back-tested return data. So I would choose a portfolio that in the past has had low drawdowns, because in the past, if it's had low drawdowns, there's a good possibility it will have drawdowns going forward, but only if we have similar economic situations, macro factors, similar economic environment than what we had during the time frame that back testing data, that's performance data, was provided before. This will make more sense in just a second, so stick with me. Okay, or I might have funds in a money market account. That's low volatility. I'm not going to have money in stocks, possibly bonds. I might buy bonds if I thought interest rates would not go up while I owned those bonds or that bond fund, because when interest rates go up, the price of my bonds go down because investors can get a higher interest rate from newer bonds. So people think bonds don't fluctuate, that they're low volatility. They're not. Okay. And it's really hard to know exactly when interest rates are going to go up and down. I'm just not that smart. So I probably wouldn't choose a bond fund for low volatility or a portfolio that held bonds, certainly bonds that are over 5, 10, certainly over 10 years, because those fluctuate the most when interest rates go up. Those are the ones that tend to go down the most because of those interest rates changing. Okay, so that was a lot. I know. Stick with me. So that's what I would do with that. And that is an honest answer to that question. Other people are going to say, oh, yeah, I would buy Vanguard, one of the stock ETFs or index funds, and with a bond, treasury bond, maybe a little cash. That's not what I'm going to say, because that's not what I do, and that's what I've learned is not necessarily the way that I'm going to get the best return within the acceptable risk for me. Okay, so the next portfolio that Hamilton had asked me to address is a retiree growth income portfolio. Okay, so I'm going to first address that growth occurs as a result of an asset increasing in price over what I paid for it. I know that sounds like such a duh, but we forget that. We forget that growth happens from us buying something that's going to rise in price, right? And the first thing that comes to my mind is, gosh, is it a good deal when I buy it? If it is, then it's probably going to go up in price, right? That's the logical thought is, am I getting this for less than market value? Because if I am, it's probably going to go up in price. And the reason that we used to buy stocks was because the companies that issued the stock had increased profits. That's why stocks were purchased, because we wanted to participate in those earnings. That's sort of the old-fashioned way that investing was done. But that's simply no longer the case. While company earnings, yes, definitely have some effect on increases in price or decreases in price, the real driver of price of stocks, asset classes, stock ETFs, stock indexes, stocks as a whole, is the amount of capital that's flowing into the stock market at any given time. And the amount of capital flowing into the stock market is based on what's called macro factors, like the economy and interest rates. And what is the Federal Reserve doing to put money into the markets? So what are they doing that results in money going into the market, I should say. So while I think there will be a time when I'm comfortable buying assets or stocks again for income, a good value portfolio that's paying good dividends, now I prefer to invest following a professionally developed ETF strategy that has over 50 years of back-tested data, so I can select and implement a portfolio that aligns with the returns I need within acceptable risk for me based on logical conclusions. What is driving prices is the amount of capital that's flowing into the asset that we own, the market that we own, and that to a great extent is a function of what's happening with these larger macro factors, the Federal Reserve actions, the economy, interest rates, the growth in the economy, the slowdown in the economy, even global economics. Those are what are really driving and affecting whether our investments go up or down in price. The portfolio strategy that I use, the one I picked out at Allocate Smartly, is based on the flow of money into or out of asset classes, because that's what makes the prices rise and fall more than anything else. Not a portfolio that's supposed to work no matter what's happening based on various economic factors. So that's how I invest, and I'm just being perfectly honest here. Sometimes stocks go up, sometimes they go down, sometimes bonds go up, sometimes they go down. It's the same with oil, with gold, with real estate. So I'm not going to sit here and tell you that this is a great portfolio for income and growth for a retiree, because my portfolio changes based on what is happening in the financial markets. Okay, I've done a couple of videos on this. In general, my whole channel is about this. It's about this reality. And if you want to check out my other videos on that, make sure you look at the Allocate Smartly review. Okay, now, if I have a portfolio that buys and holds stocks, bonds, gold, or any other asset, when capital is flowing out of that asset class, the price of my investments will decrease. So my goal is just to manage and limit those decreases while getting as much upside as I can. Okay, now the third type of portfolio that Hamilton asked me to present here or to talk about is a strictly income portfolio using ETFs. I don't use ETFs for income unless I'm selling cover calls on the ETFs. I've talked about cover calls in other videos that I've done here. If you're interested in cover calls, be sure to check those out. Sometimes I do sell cover calls for extra income, and sometimes I sell them on ETFs. I've also sold a bunch of them on stocks, but I also sometimes sell them on ETFs. It depends on a lot of factors and if they make sense at the time. I use ETFs, so really in my portfolios for total return. I don't think of it as so much as income versus capital gains. I think of it as total return, both the income that they generate and the capital gains. And that's more how I think about my portfolio. I talk a lot about income generating assets. I love my rental real estate properties. I love assets that generate income, but I don't so much think about that with my portfolios, separating the two. I more go for total return. If I wanted income from a portfolio, traditional portfolio, I would buy assets that pay the highest return with the lowest risk at any given time. And that might be different in 6 months. It might be different in 1 year. It depends on what's happening at any given time. That's how I invest. For example, in 1980, municipal bonds were yielding over 20% tax-free. Tax-free. So taxable, that would be like, what, 25, 30%, okay, if we did an equivalent for a taxable bond. So is this even relevant? 1980, that was forever ago. Is that relevant? I'm old. That was a long time ago. Is it relevant? Why am I saying this? Oh, you bet it's relevant, because the point is that things change and the macro factors change, and when they do, the price of assets change. The price of your investments and my investments change, except for usually money market fund accounts, which, hopefully they'll stay the same. And there is a little risk there, but I'm not going down that rabbit hole right now. That's what I wanted to share with you in this video. If you found this information helpful, please subscribe to my channel.